Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. Today we have our resident commodities mentor, Rick Rule. We are going to talk about our big thinkers, debt and deficits, gold, uranium, coal, oil, natural gas, and nickel. Rick, thank you for coming back on the show.
We're going to talk about all that in my remaining lifetime. That's impressive.
Yes. Well, let's get right to it. Okay, so I've been I got to say, you and David Stockman called it. The Doge committee was less than stellar. I don't want to say they've done nothing, but they've done nothing of any real significance. I even saw a recent report, although I haven't verified it, that Elon has stepped down. I guess he's realized what David did 40 years ago, and it's just not working. The bet I keep coming back to, like the last time we talked about, is gold. You know, I've been looking at the sports betting sites of trying to find a little avenue there, and gold just seems to be working, and I think that's the bet in this economic environment.
Steve, you and I have a mutual friend. I won't name him because of privacy. He's both an investor and a trader. He's a listener of yours, former client of mine, and he has gold in his portfolio, which is sort of permanent, but he also has trading gold. He bought gold back at sort of $1,500, thinking it was way underpriced and that it was going to go through $3,000. And I was talking to him the other day, and he said, "What should I do with that gold?" And I said, "Well, you bought it for a reason. You bought it because you thought the price would double. Now the price has doubled. For that portion of your gold, you should sell it. You're a trader." And so your response to gold depends on who you are, what reason that you bought it, and what position it plays in your portfolio. It's important to note that in the period 2000 to 2025, the gold price has gone from $250 an ounce to almost $3,500 an ounce. It's up 12-fold. When people ask me when gold's going to move, and you've asked me that, I've said it's going to move in 2000, which is done. For me, I believe that the next 10 years is going to be very good for gold. But beliefs aren't worth much. Gold fulfills a place in my portfolio. It provides insurance against circumstances that we'll talk about later in this discussion. And it also provides liquidity. I consider gold to be good if volatile cash. But I realize that I'm different than many of our listeners. So your own listeners are going to need to develop their own framework for their own portfolio and where gold fits into it. This I can tell you, Steve, gold fits in every portfolio. The gold price is up 12-fold in 25 years, and ownership of gold in the U.S. still constitutes less than 0.5% of total savings and investment assets in the United States, where the 4-decade mean is 2%. I believe that gold's market share in this market will at least revert to mean, which means that demand for gold should grow 4-fold, which is what I believe is going to happen. I have no idea what that will do to the price, but I suspect it will be attractive.
Yeah. Now, we've talked before, and you taught me that when you're betting on this, you essentially start with physical gold, bullion. After that, you move into a fund like PHYS, which is, I do air quotes, physical gold on the stock market. After that, you move into the majors, and then the mid-tier, and then the juniors, and then at the last end of it, you call them the penny dreadfuls, like the explorers and, you know, the real risky plays. Where in that cycle do you think we are?
Well, I would argue a little bit about your first statement. I don't personally see an awful lot of qualitative difference between owning physical gold and the physical gold surrogates.
Okay.
I own both. I understand some people say if you can't touch it, you don't own it. I respect that. But I'm less concerned about how somebody owns physical gold. But I think you have to own physical gold. In my experience, you visualize a precious metals bull market like you visualize a circus master's whip. The front of the whip and the whip handle is the physical gold. It moves first. Afterwards, the very best gold stocks move, and they're just starting to move now. After that, the lower quality, the intermediate, the high quality junior producers move. Then the developers move, then the explorers move. That's the way it works. And you can follow that continuum, which has been proven in history successfully. I operate in all aspects of the continuum all at once, but that's just me. We're doing this upcoming boot camp because we see now that the probability that gold at least maintains its current price, but probably increases, means that the senior producers are going to enjoy greatly increased margins and free cash flow. And the market has begun to notice this and will continue to notice it. So we believe that we're in the part of the bull market where leadership changes from the bullion to the highest quality gold stocks. The upcoming boot camp this Saturday will deal with the very high quality gold stocks. Not just, although focused on, the biggest and best royalty and streaming companies and producers, but also the very, very, very high quality smaller companies that are likely either to move with this bull market or be taken over by other companies. The subsequent boot camp, 90 days from now, will encompass the rest of the gold miners. These companies traditionally move last, but they move fastest and they move the furthest. And so the first boot camp that we did about 90 days ago focused on the reasons why you own gold and how you own physical gold. Extremely well timed and a great boot camp. This boot camp will talk about the leadership change from physical gold to the highest quality gold stocks. Again, beautifully timed. And the last boot camp will talk about when the baton changes one more time from the highest quality gold companies to the rest of the gold companies.
I really look forward to this. I've gone to all your boot camps, and each one of them has been really, really good to our brokerage accounts. So I'm really looking forward to this one. We'll put a link down in the pinned comment below and in the show notes below. And yeah, I'm really looking forward to it. I don't know what companies you're going to have up there, but I'm sure they will perform just like all of your other boot camps. I'm excited.
I think a couple things need to be said about the boot camp. Three things really for people planning on attending. First of all, it's 8 hours long. And there's no polite way to say it. We're going to kick your ass over 8 hours. We're going to give you more information than you can absorb in 8 hours. So we're going to make the transcripts available for a year, and you're going to have to replay them. You're going to have to do that to get your money's worth. So if you're the type of person, I like to say, who buys the Sunday paper to do the crossword puzzles and read the funnies, don't come. Just don't come. This is a lot of work. This is a lot of information. The second thing is that we have an extraordinary faculty. We have John Hathaway joining us. He's a long-term friend and colleague of mine. He's been investing in high-quality gold stocks for 45 years. It's not like he's some Johnny-come-lately guy who flunked out of crypto and flunked out of pot stocks. This guy's made money where the rubber meets the road since the 70s in the gold equities market, a value investor who transitioned to gold. Superb human being. We have Adrian Day, who's been investing in gold equities almost as long as John Hathaway. A guy who started really in the penny dreadfuls and worked his way up to the best of the best, the experience that one gains after 50 years in a market. And then we have Joe Mazumdar, who is a really world-class geologist who can talk about the geology of world-class, high-quality deposits to help you, the investor, segregate between the good, the bad, and the ugly, because you're going to be confronted with all of it. The last thing I'll say is, like all of our investor education products, if you think for any reason after 8 hours of intensive programming that I didn't earn the $99 fee that I'm going to charge you, I'll give you your money back. This is a riskless financial transaction. There is no other purveyor of investor education that I know of that offers a full unconditional money back guarantee. To get your money's worth, you have to come and pay attention. Don't be petting the cat, you know? Then play the tape once or twice. Then attend the discussion groups at the Rule Classroom and compare notes with other attendees to the boot camp. The ability to access the notes of 12 or 13 other people is way better than relying on your own notes. So it's important. It's designed as a total immersive experience. And it's designed to make you not a little money. It's designed to make you a lot of money if you do the work.
Yes, yes. It being in the Rule Classroom has become part of my daily routine. And there's kind of a core group of us in the Rule Classroom Plus that's behind a little bit of a paywall. But man, the guys behind there, some of them are do this for a living, and
Yep.
it really gives you access to some incredibly intelligent people, which is a lot of fun. Um, okay, I'm going to share my screen here, and this is the Fed funds rate, and this is essentially the Fed funds rate over your lifetime, Rick. So this is in the early 50s, and we can see the interest rates going up until the gold peaked here up in 1980, and then we've had an environment of structurally um, how can I say this? Structurally declining interest rates, and how can I say this? Like the debt payments were relatively stable because as the debt was increasing, the interest rates were falling. Well, we've now come to a point where it's the other way around. We're starting to reverse here, and if I can overlay gold with what's happened, this is the green here is the price action of gold, and you can see if you just line up right here where they start increasing, gold just skyrockets. Like I could see a scenario where this continues to just do one of these, right? Kind of go like that,
Yep.
higher highs, and higher lows. I got to imagine that this is going to be doing the same thing, and when you can leverage that on gold stocks, this could really truly be parabolic.
This is a fascinating chart. And I think it brings up a couple of points. The first is that your suggestion with regards to higher interest rates has a lot of validity. If you look at the fact that the Congress and the executive and the Fed are all trying to jawbone interest rates lower, and they're adding liquidity on the near end of the yield curve, but the long end of the yield curve is still moving up. That tells you that perhaps like the Clinton years, the bond vigilantes are taking control of the interest rate from the Fed, which is
Yeah,
to say the Fed is losing control of the long part of the yield.
yeah,
If that happens, your suggestion with regards to the Fed funds rate is true. What would be fascinating, and I don't know how to do it, Steve, is to overlay on this chart not the CPI stated rate of inflation, but some sort of chart that maps the deterioration in the purchasing power of the US dollar relative to the interest rate. Because I suspect that the response you've seen in the gold price isn't merely interest rate sensitive, but rather is sensitive to the delta between the deterioration in the purchasing power of the US dollar and the US dollar return on capital employed in savings. If I'm correct, although the CPI says that the rate of deterioration of the dollar is 2.5% a year, when I look at the basket of goods and services that I buy, Steve, it occurs to me that the deterioration of the purchasing power of my savings relative to the goods and services I buy would suggest that the purchasing power of the US dollar is declining by 7.5 or 8% a year. And that's the rub. If the Fed funds rate, which is what determines deposit interest rates and the 10-year Treasury rate, is at 4.3%, and the deterioration of my purchasing power is at 7.5%, I'm losing 3% a year.
yeah,
And what traditionally has moved the gold price, and I'm talking about for 1,000 years, is investors' perception that fiat currency denominated instruments are costing them real purchasing power. If I'm right, and we have a 300 or 350 basis point, 3 to 3.5% real difference between the deterioration of the purchasing power of the currency and the interest rate available on so-called risk-free savings, I think gold continues to do very well. And I think that your chart in that case is prophecy.
Okay. Okay. What could you say if I could put it on the chart? We're getting together on Thursday in the real classroom. Maybe I can have the chart done by then. I'll have to figure out how to do it. You're saying the deterioration of the U.S. dollar in relation to the CPI. What was the formula?
Well, I don't know. That's what I was asking you. I don't know. I mean, John Williams at Shadow Stats has a uh, different definition of inflation.
Yeah.
Perhaps you could average the Shadow Stats rate with the CPI and get a rate that's closer to the truth.
Ah. Okay.
The CPI, among other things, doesn't measure tax. And it's the largest cost of living for most Americans. The idea that you construct a cost of living index that doesn't include 35% of the economy seems very strange to me. But even if you leave tax out of it, if I look at the period, my memory is not as good as it used to be, Steve, but if I look at the period 2000 to 2025, and I look at what's happened to energy prices, gasoline prices, grocery prices, health insurance, health care, rent, mortgage interest. The idea that my purchasing power has been declining at 2.5% a year is silly. It's silly. And I'm an old, bald, fat, rich cheapskate. I don't spend much. If you compare me with the average listener that you have that has a life and has children and stuff like that, I suspect that I suspect that my estimates are conservative. And if we could construct a reasonably accurate, not a totally accurate, but a reasonably accurate statistic for the deterioration of the purchasing power of the US dollar, and then juxtapose that with a return on, and I probably personally wouldn't use the 10-year, the Fed funds rate. I'd probably use the 10-year Treasury rate because that's what's available to savers.
Okay.
It's the delta between those two
Yeah.
that drives the gold price.
Yeah. Yeah. I could put the CPI up there, but maybe I could add like somehow 4% a year or something to the CPI because that's probably closer to
Yeah,
the
I
truth.
don't know how you do it.
I
Uh,
don't either. I'll have to research that one. I'm sure this program can do it though.
Yeah. My 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 search for simplicity would probably use the shadow stats number
Okay.
and average the shadow stats number and either the Fed funds rate or the 10-year, pardon me, average the shadow stats number with the CPI number.
Okay.
I think if you added the two together and then divided by two, uh, you'd get reasonably close without too much effort.
Yeah. Yeah. Yeah.
Though without too much effort, it's a good thing.
Yeah. Okay. All right. I can't do that live here on the air, but I'll see if I can figure it out afterwards. All right.
I can't do it at all, so God bless.
All right. Oh, this was just a kind of a quick question here. Do you have any rules for how many shares or how much shares a CEO should own of their company? For example, like Robert McLeod, the CEO of Nations Royalty, he owns. Last time I did the math, it was 3 times his annual salary in shares. In other words, if he makes 300K a year, he owns like 900K worth of
Yeah.
um, of the stock. Do you have any rules like that?
Yes, I like 5 times.
Okay, 5 times.
Now, a young CEO will say, I can't afford it. To which I say to the CEO, the fact that you can't afford it means you haven't proven yourself in past deals. They don't like that. But you look at Bob Quartermain, now CEO of Dakota. He's decided that the appropriate salary for himself is $1. He has a rather generous options package, but he owns a boatload of stock. I like that. What that means is that if Bob works hard and creates value, he's going to make a pile of money. If he fails, he's going to hurt.
Okay, okay. All right,
I want
5x.
I want equivalence in incentive.
Yeah, yeah. Because that basically tells you as a shareholder that they care whether the price of the stock goes up or not.
Yeah, what they're in it for.
Yeah,
In addition to salary, you need to look at bonus. You need to look at total cash compensation because a lot of people have convinced their board of directors that they should get a bonus for breathing. I looked at a compensation table yesterday in a company that I own, and the recommended bonus to the CPI to the CEO is 100% of his salary. Last year, because he exceeded unnamed goals, he was awarded 120% of his salary by way of bonus. I love incentive compensation, but I like the incentive compensation to be in either options or deferred stock units, which is I like to see them paid in equity.
Yeah.
It's
Okay.
illusory to define executive compensation mainly by way of salary, because often compensation plans have restricted stock units, designated stock units, options, bonuses, and salary. And a CEO that shows being paid 400,000 a year is often being paid $1.8 million. Nothing wrong with that person being paid $1.8 million, but you ought to know how much of that compensation is what is contingent and what that CEO needs to do to earn that contingent compensation other than merely breathe.
Okay. Um, we recently had some news on Origin Royalties. They got an offer from Triple Flag Precious Metals for their Silicon Merlin deposit. There was an instant re-rating of the stock. It shot up 30 something percent. Have you had a chance to look over that?
Yes, I have. And by the way, congratulations on a superb interview with Patty Nickel.
Oh, thank
Uh,
you. You watched it.
I did. I'm a huge fan of Patty. I've known him since he was a green behind the ears, consultant 30 something years ago. Truly superb human being. I like this transaction. I'm taking my compensation in Triple Flag shares. I think the Triple Flag paid a full price for a superb asset. I believe that Triple Flag may sell off, and I believe that the Origin stub may sell off after the transaction takes place
Yeah.
because other investors have a shorter term perspective than I. And I will be an aggressive buyer of both if they sell off.
Okay. Okay.
Um, you and I have talked a lot about Origin uh, on your show over the year, and it was very obvious that 3 years ago people underestimated the impact of the cash from Ermitaño. They also underestimated the fact that Origin has such a good prospect generation or royalty creation business. But in particular, people didn't keep up with the work that Anglo was doing, increasing the size of the asset that was just sold. Um, and I think Patty did a really good job leaving enough on the table to bring a high quality suitor in place, delivering them an asset that will improve operations even in a company the size of Triple Flag, while at the same time preserving the upside that the market wouldn't pay for in the same corporate wrapper that delivered the value. Truly spectacular. If you have never done so, Steve, I would suggest that you interview on your show Brian Dalton, the CEO of Altius, who is even larger than me on the Origin shareholder roster. Brian is a superb allocator of capital and a superb prospect generator and royalty investor himself. And his company, Altius, is the largest Origin shareholder. He in Altius holds another, I think it's 1% royalty on these same assets, and is probably a better determiner of what the net present value is. He was in favor of the sale on the terms.
Yeah.
There is
Okay.
nobody who knows the value of that asset better than Brian Dalton.
Okay. I will reach out. I don't own Altius, although I've looked at them for like a year and a half, and I've just never pulled the trigger. I probably should. I just give me an extra hour a month, you know?
Yep. Yep.
Yeah. Okay. Let's move on to. I think we're going to have to. Well, do you have any quick thoughts on? Have you looked at Trump's fast track list on? This is courtesy of Matt from Twitter. This is his basically his Fast 41, I think is what they're calling it, trying to fast track like the Resolution Copper project. I see some names in here that might be of interest to the listeners. Hecla Mining, Glencore. Is this all? The more I study politics, the more I hate it. Any thoughts?
Yeah, let's move away from this because you would have to discuss each asset in the state and local context as well as the federal context.
Okay. Okay.
Let's talk about what Trump is doing that's good.
Okay.
I've run into a lot of hate on social media for expressing skepticism with regards to Trump and my opposition to tariffs and my hesitancy about Doge. But let's talk about where he is doing something. And that is that apparently any executive order passed by a former president could be abolished by executive order by a current president. In other words, stuff that wasn't passed through Congress, but was rather done by executive proclamation could be undone by executive proclamation. Much of the economic damage that was done in the Obama administration and the Biden administration was done by executive decree, executive order. And Trump has already started to reverse this. This isn't progress that's in the mail, like Doge. This is current improvements. These improvements are being particularly felt in the U.S. natural gas business. What was happening in the U.S. natural gas business had been that the regulators weren't necessarily turning down projects, they just weren't dealing with them. There was, I believe, a deliberate go slow. The Trump administration is very different with regards to that. They're go fast. Go fast for drilling, go fast for gas storage, go fast for gas gathering system, go fast for gas transmission, go fast for gas liquefaction, go fast for industrial beneficiation, where German fabricators who can't buy gas in Germany are relocating their fabrication facilities to the U.S. with access to gas. Trump has reached out to people in the U.S. uranium industry, including to myself directly, saying, how can we help? What can we do? By the way, what we can do is if there are obstructions that exist because of prior executive orders, we can fix that toot sweet. This is different, and this is important. This is something that Trump has the absolute ability to do, and he also seems to have the willingness to do it.
Wow, that's cool. He reached out to you?
He didn't.
His staff did.
But people known to both of us have said, you know, you have been in the U.S. uranium business for a very, very long time. We don't have the 40 years that you've spent learning the business. We have 4 years. So what can we do and how can we do it? What are the impediments that you think are political? And if they are impediments that exist as a consequence of executive decree, we can fix them very, very quickly.
Wow, that's encouraging. That's pretty cool. Okay.
What investors need to do is they need to juxtapose this federal thaw with the understanding that resource development regulation in the United States is tripartite, federal, state, and local. So after you have de-risked the federal, you need to focus on states that are also permissive. At present, I would suggest the A-list states are Texas, Wyoming, Nevada, and Alaska. The B-list states, which is to say the improving states, are probably New Mexico, Utah, and Idaho. The states where progress is in flux probably include, importantly for the copper business, the state of Arizona.
Yeah. Okay. All right. So the ones that after talking with his people, you basically said you need to focus first on Texas, Wyoming, Alaska, and what was the other one?
Nevada.
Nevada. After that, second tier would be New Mexico, Utah, and Idaho. And then especially you were talking about the Resolution copper deposit, I'm sure.
Right.
Yeah. Okay. Awesome. Wow. I did not expect that. That's pretty cool. It's,
It's
and
been
oh,
it's
go
been
ahead.
very heartening, and I think saying something finally positive about the Trump administration will lower the level of social media hate I get from Trump supporters.
Yeah. Good for you. That is pretty cool. I hope someday I'm in your shoes. Okay. So piggybacking off of that, macro thoughts on uranium. Do you think we've seen a bottom? What are your thoughts?
I don't know, but sometimes stuff is cheap enough.
Yeah. Yeah.
I note that the market capitalization of Paladin now is less than the market capitalization of Fission when they acquired it. You get the rest of the Paladin assets for free. And you get the ability that the Paladin team has to use term contracts to finance not one, but three mines into production. That's cheap enough. Will
Yeah.
it be cheaper a year from now? Maybe. I don't know. I don't have a crystal ball. But I suspect that while people may or may not be happy about the uranium complex a year from now, they'll be ecstatic 5 years from now. And I've learned even at age 73, I don't think in 1 year time frames. I think in much longer time frames.
Okay.
I'm also encouraged, by the way, that last quarter in Cameco was a really good quarter. It was really good in many regards. The price per pound sold means that some of the old low price contracts worn off. They won't tell you what median price their contracts are at. So you have to work backwards from the quarters. But the other thing that happened is you recall that you and I talked about 9 months ago, and I was scared to death about the financial performance of Westinghouse.
Yeah.
And it looks to me from the last two quarters that Westinghouse has really, really turned around. And that's really important to Cameco. I read the quarter and then I reread the quarter and then I read the quarter backwards, paying attention to the notes and the financials so that I could use the information from the notes and the financials to make more sense of the interplay between the balance sheet and the income statement. And that was a damn good quarter.
Okay. Encouraging. Do you see? I don't know if you've calculated this or not. I've tried to do Google searches to figure it out, but like electric demand from data centers, kind of the order of no. Okay.
No,
Okay.
I
I haven't
mean,
been able to
I
quantify it
think
either.
the data center demand increases are in front of us. Uh, I, I pay attention to levelized demand, which includes stuff like air conditioning. It's mundane, but it's a very, very, very big number.
And last time we talked, you were more bullish on thermal coal as opposed to met coal. I'm sure that nothing's changed in a month.
Yeah, I mean, I think they'll equalize out over time. It's just that people hate thermal coal so much. There seems to be an acknowledgement, even among the Greens, that whatever they do requires steel. There is no similar acknowledgement for the fact that very poor people, when they hit the switch on the wall, want the lights to come on. That's thermal. Uh, Thermal is more thoroughly vilified than metallurgical, and hence it's cheaper. But poor countries are building thermal plants like mad.
Yeah.
So whether you like it or you don't, leaving the rhetoric aside for those people who can leave rhetoric aside, hated assets are cheap.
Yeah. Okay. All righty. Let's move on to oil and gas. So, oil's had a nice little correction. I've been pretty excited about this. We thought for a while that oil could have a bit of a correction here, and it's finally happened. Let me take off the gold chart here. But we're just kind of this was our floor, $67 for several years. We've finally broken below it, and is $55 oil, is that sustainable? What are your thoughts?
It is not.
Okay.
But as you notice in the part of your chart that covers the COVID period,
Yeah.
if you have demand destruction, you can have price destruction for a while. The International Energy Agency suggests that the total worldwide cost to produce a barrel of oil, including social rents, which is to say tax and royalty, and including the cost of capital, not just lifting costs, but the total cost, is about 60 US dollars per barrel. So if you make the stuff for 60 and you sell it for 60, there isn't much capital left over to drill replacement reserves or to make sustaining capital requirements. You can have extended periods of time, as you can see in your chart, where the oil price is lower than replacement price.
Yeah.
And you also see wonderful evidence on your chart about what happens in recovery, which is to say it overshoots to the upside.
Yeah.
The way that you invest in capital intensive cyclical businesses is you have the guts to invest in industries in liquidation, which the oil industry was for the period 2020 to midway through 2022, with the understanding that those periods destroy enough productive capacity that when demand comes back, the price overshoots to the upside, which you see very well demonstrated in your chart. How far the down leg that you see on your chart occurs really depends on the economic damage that is done by the end of free trade in the world. The recession that happens as a consequence of global politics. If the economy continues to slow, and you're seeing evidence of that slowing economy in credit demand, in oil pricing, in copper pricing, to the extent that our political leaders conspire to deliver a full-blown recession, you could see the oil price break down much further. If it does, you will see a much higher recovery. That's the way markets work. I'm not saying that's going to occur. I'm saying that the consequence will be a disproportionate recovery.
Okay. Well, that's kind of encouraging because the further the fall, the further the spike back up, like we saw in
Correct.
yeah.
Here's what I can tell you. $60 is not sustainable.
Okay. Okay.
There are plenty of companies like Exxon that would make some money at 40. But Pemex, the Mexican national oil company, PDVSA, the Venezuelan national oil company, those inefficient parastatal producers absolutely lose their behinds at these
Okay.
prices.
Okay. Okay. So if we see uh, let's say it gets a little crazy, it gets down to 40, $45 a barrel. Do you see Chevron and Exxon continuing their dividends, or is that all a factor of how long it goes
Hopefully
for?
not.
Okay.
Hopefully at 45 dollars, they put any surplus cash they have into buying strapped competitors.
Ah,
The
okay.
idea that they pay me a 3% dividend yield, as opposed to generating 30 or 40% returns on capital employed by redeploying that money back into their basic business. I would prefer that rather than pay me 3%, that they generate 30 on that same capital.
Okay. Okay. So you could see a lot of M&A, a lot of mergers and acquisitions coming together if we get down
Yep.
to those levels.
Yep.
Okay. And the biggest ones in the business, Exxon and Chevron, Total, Shell.
And Steve, we should talk about one more thing in the oil business because it falls on discussions that you and I have been having for 2 years. The Canadian business is cheap, but the Canadian business ran headlong into my worst fears, which is the election of Mark Carney in
Yeah.
Canada. Carney is, I think, responsible for many of the anti-energy policies initiated by Trudeau. The difference is, unlike Trudeau, Mr. Carney is superbly competent. I would prefer an incompetent enemy, which is the type of enemy I had in Trudeau. I still own 7 Canadian oil and gas companies because they are so cheap and they're so well run. But in terms of political risk, my worst fears were recognized, and they were recognized in a landslide win by the enemy.
Yeah, yeah. I saw the blip about Alberta, how they're talking about seceding. I wish them luck.
Right.
Okay, to wrap up here, nickel. I went to a Volkswagen electric vehicle, basically R&D research facility recently. Got a tour of it. It was pretty cool, and I was talking to the engineers there, and my main thing was, how much nickel are you guys using? And much to my dismay, they said that they've been phasing out nickel and they've been focusing more on lithium and lithium iron. And their accent was really heavy. I wasn't sure some of the things that we were looking up on, Google Translate of like, what is it that they're saying here? But then when I look on Google, they say that nickel is being used more in EVs. Do you have any insight into that?
They're both true. I think the way the engineers were answering your question, there is less reliance on traditional lead acid batteries, but the lithium battery is a lithium, nickel, copper, cobalt battery. There is more metal by weight in that battery that's nickel and copper than there is lithium. So, like the old Purolator oil filter, you can pay me now or you can pay me later. It's both okay. The problem in the nickel market is not displacement of nickel by other metals. It's the increase in supply from lateritic nickels in the Philippines and Indonesia, particularly, and the attendant environmental damage that's happened. The difficulty with nickel pricing has been on the supply side. Note that that supply is very energy intensive. And so lower oil prices, for however long they last, will encourage supplies of lateritic nickel, which will mean that as long as energy prices are low, there is some incentive to produce, and it should be hard relative to other circumstances on the nickel market.
Okay, okay.
Note too that there's no stimulator of demand like low prices. The low prices that you see in the nickel market means that metallurgists and engineers are experimenting with new ways to use nickel every day. And they aren't experimenting with ways to substitute other metals for nickel. And so the low prices that you see today stimulate demand that will move the prices 5 years from now. You remember you and I talking 2 years ago about the fact that natural gas prices at $1 per million BTU would lead to increased consumption and increased utilization of US natural gas, which is precisely why, although output levels of natural gas are higher today than they were 2.5 years ago, the price, rather than being $1 million per BTU, is $3.50 per million BTU.
Yeah, yeah.
Markets work. The cure for low prices is always low prices over time. You will see that happen in the nickel business, but you won't see it happen in 2025 or probably 2026.
Okay, okay. Still got some time. All righty. Awesome. Well, thank you very much, Rick. Do you have any final thoughts?
I have three. The first is that if you like what I have to say about natural resources, your listeners can personalize it. Go to ruralinvestmentmedia.com, list your natural resource stocks. I'll rank them for free, 1 to 10, 1 being best, 10 being worst. Be patient. I'm 96 rankings behind. So expect it's going to take, I don't know, 8, 10 days because I rank them. I rank each account individually. The second thing is if you are underweight gold in your portfolio, fix that. Fix that. In particular, fix your own attitudes with regards to gold by coming to our Gold Investors Bootcamp this Saturday. It's $99. If for any reason you don't think you get your $99 worth, I'll give you your $99 back. This is a riskless transaction for you. Finally, the best investor education event that I put on, graced by Steve Barton live, is the Rural Natural Resources Investment Symposium in Boca Raton, Florida, July 7 through 11. attend in person or join a couple thousand people from 30 countries and attend the conference online. Either way, you get access to a year's worth of the recordings, which you will need. And again, you have an absolute solid gold money back guarantee. If you think for any reason that you didn't receive value for the money that you spent attending that conference, live or in person, we will refund your money.
Awesome. We will put links down in the show notes and in the pinned comment below. I'm looking forward to the boot camp this Saturday. As all your boot camps, they are very good to our brokerage accounts, and I can't wait to be out at the Rural Symposium. Last year was a blast, and I expect that this one will be as well. Rick, thank you very much for coming on the show.
Steve, thank you for the opportunity to talk to your audience. I enjoy it.
Yes, and thank you for tuning in. Go to stevebartonmoney.com for more and have a wonderful day.